Well, welcome. This is Genus' fourth weekly look at the markets during our virus event. Wayne, we talked about the three stages of what the market does in these kinds of instances. The first being a panic, which is really caused the market to go down about 50% from mid-January to about March 22nd or so. The market's up 25% off the bottom. Very nice bounce. So what's driving all that?
Well, this week, the big news was the pandemic cresting. It crested and the market went up with that. And so market has been looking for that. It happened on time. Very similar to China. And the second big factor this week was the Fed undertook shock and awe. They're coming in big time. There's a $2.3 trillion loan facility in place for businesses.
Yeah, no, these numbers get meaningless because they're so big after a while, but this is on top of 2 weeks ago of 2.2 trillion, which is also shock and awe back then. So it's enormous. Tell us what this has done to the bond market.
Well, that, and also the fact they're actually buying corporate bonds, they're buying junk bonds, they're buying corporate ETFs, has had a dramatic impact on the corporate bonds. The big corporate bond ETF in the US, the LQD, is now flat for the year after being down probably almost 20%. That's amazing. They're the buyer and moving that whole market. Junk bonds spreads have come in dramatically, and the junk bond ETF this morning, this today was up like 5-6%. 2 weeks ago, Ford Motor bonds were downgraded to junk. Today they were up $20, and so that's the Fed. They're coming in. They're the buyer of last resort. They're holding these junk bonds up effectively, and they will buy. If Ford has to issue bonds, they'll be there probably buying them. This is kind of dangerous in some ways in that basically it's moral hazard. Where does this stop? How long will this go on? For 2 months, for 3 months, for 4 months? What happens after 6 months? Will they still be in doing this? So they're coming in big time.
I think one of the things that's concerning, that's great that they're doing this, it has to be done because liquidity is a huge problem in these kinds of markets. And what I heard, a Humpty Dumpty theory today, if Humpty Dumpty crashes, you can't put them back together again. So it's really important that they've come in and done all this. But the fact that the 10-year US government bond yield is still as low as 72 basis points tells me that there's still a lot of uncertainty and fear out there. Because that should be going up, because this is obviously inflationary. Interest rates should rise across the board, but they're not. They're only rising where the Fed's buying.
Yeah, and I think that's a big tell. We saw gold move a bit through the course of this week here. It was up 2% today. And with all the money printing going on, we anticipate gold longer term to break out. We're overweight gold miners at this point in time. We have gold in our global macro strategy. But they're printing so much money, and it's going to have implications longer term. My sense is I've been in the business for 40 years, and for 40 years there's been disinflation. Rates have fallen for 40 years. My sense is we're coming to an end of that era. We're going into an epoch where it might be inflation, where the governments are involved in printing too much money and getting too hands on the economy. I don't know where it's going to end up, but I think the era we grew up in, career-wise, is coming to an end.
Well, no, I remember the before it, 1981, just a few years, but it was dramatic. When Volcker got inflation under control in the early 80s. So this leads us to the obvious question of the third issue, which is the retest. And we talked about this last week. Everybody's talking about a retest, although less this week. We're still nervous about that, aren't we?
Yes, we're still concerned about that. And stocks have done so well here. We've started shaving some equity in our global macro strategy. It's more of a trading thing. We're looking at our other accounts as well in the coming weeks as well. We've got a 50% retracement here, and our equity weights have actually gone up. So we just want to reduce those back to where they were prior to this rally. And then we'll take a look.
Rebalancing we talked about before.
Yeah. And our global macro models came out this month. And our world to cash model, which was positive last month and before the pandemic, has gone to kind of flat to negative. And so that's giving us pause. What's going on there is a lot of the indicators, the risk indicators, are really off the charts. And they're knocking down the model's buy signal effectively. And so we want to watch that and take it. So there's some caution here. I still think we're going to get a bit of a correction from where we are today. Maybe we might go to a bit higher here, but I think once we start digesting earnings and the mess out there, there's room for maybe a retest, maybe not all the way, but some downward movements here before we go on from there. But we'll be watching our indicators and signals and making the right adjustments.
Well, I just want to talk about the virus for a minute, just because the markets and the virus are so interconnected. There's a great article in The Economist this week about how do we kickstart this? How do we get going again? And, we have discovered that globally we have these fantastic public health people, including our famous Dr. Bonnie Henry here in British Columbia, who we all love. But they are rightfully so totally focused on the virus. It seems that in order to restart the economy, we need leadership to look at things like suicide rates, abuse, critical heart, critical cancer care, other things that are being put on hold, including going to work, while we, put on these draconian appropriate measures to get the curve flattened. But it's going to take very wise leadership to create policies that get us restarted, because the vaccine, if you listen to Bill Gates today, you can Google him, he's on Fox and PBS, he's a great interview, just listen, it's not going to be solved overnight. So, but we have to get going. So we need these global leaders. I can only say, thank God Angela Merkel is still involved, and thank God Boris survived. And I hope that other countries can step up. You see Singapore and Japan, second wave happening. So we need global leadership. And the one country that starts to get it right, whether it be Sweden or anybody, we can all copy them. We need to learn from each other. The scientists are cooperating. It's really unbelievable. But we're far from out of this mess. And that's one of the things I want to make sure the clients know, is that this bounce is it's got some air under it.
Well, there definitely is a cost benefit here, and we'll see how this plays out in terms of the impact on lives and even people that can't get care right now that have other medical issues.
Right. Just quickly, what have you done this week? Not stocks, just big picture. You don't normally do big rebalancing weekly. Yeah. Have you done anything this week?
Well, we did within our balance funds. We bought some more of our global macro bond fund and sold some corporate bonds to do that. We're looking at actually reducing some equities and probably putting that into cash over the next couple of weeks. Within the equity funds, it was a good week for value, for risk taking, if you will. So value stocks came back this week. We've been adding to value somewhat. We actually, through the course of the week, we actually sold some healthcare, for example, and bought some banks, the higher quality ones. And that's really what the extent of it.
Right. So I think we should wrap this up. I'm sorry, I have a couple of great questions, but they're on another paper in another room, and I forgot to bring them in here. So next week, I promise we'll get to your questions. Sorry about that, but it is Easter weekend. It's a tremendous, important weekend culturally for all of us, different religions or not religion, but it's a special time. So I wish you all a very happy Easter weekend, and rest assured we're hard at work overseeing your financial situation. Thank you very much.
Thank you.